Look, I need to tell you something about precious metals that most investors, even sophisticated ones, completely miss. We're not in a normal bull market. We're watching a structural shift that's been building for years, and it's about to accelerate in ways that will catch people completely off guard. Here's the macro backdrop. We're at the end of a debt supercycle. The US has $36 trillion in debt. Japan's over 250% debt to GDP. Europe and China face massive structural debt issues. When you're this deep in debt, you have three options. Default explicitly, grow your way out, or inflate it away. Explicit default is politically impossible. Growth is unlikely given demographics. That leaves inflation, financial repression, where real rates stay negative and currencies lose value. This isn't theory, it's already happening. And when currencies devalue by design, you need assets that can't be printed. Central banks understand this. In the last 2 years, gold buying by central banks has hit record levels. China, Russia, India, Turkey, Poland, they're accumulating at unprecedented rates. Why? They're diversifying away from dollars, preparing for a multipolar world where dollar dominance is diminished. When central banks, the most sophisticated players, are buying aggressively, pay attention. And it's not just central banks. Wealthy individuals and sovereign wealth funds are accumulating. The only group underweight is Western institutions and retail. That positioning asymmetry is critical. Silver is where things get explosive. It has dual nature: monetary, metal, and industrial commodity. We're running a 150,200 million ounce annual deficit. Consumption exceeds production, and we've been drawing down inventories that are now at multi-decade lows. Demand is accelerating. Solar panels need silver with no viable substitute. EVs use 2-3x more than traditional cars. 5 grams, AI data centers, medical tech all require silver, and solid-state batteries could increase silver content per EV by 20-30x. If 20% of EV production shifts to solid-state batteries, that alone consumes 25% of global production. Add solar, electronics, traditional demand, you're at 150,200 of supply. Prices must rise dramatically. Here's the kicker. 70% of silver is a byproduct of zinc, copper, lead mining. Even if prices double, supply doesn't respond quickly. It's structurally inelastic. This creates conditions for explosive repricing. The gold-silver ratio sits at 85:1. Historical average is 40-60:1. The ratio recently broke from 130:1 and is compressing. If it normalizes 250:1 with gold at $3,000, silver hits $60. In late-stage manias, ratios overshoot. In 1980 it hit 17:1, in 2011 it was 32:1. If we see 25:1, silver reaches 120 plus. The geopolitical shift is massive. We're moving from a dollar-dominated unipolar world to multipolar. BRICS nations are actively de-dollarizing, settling trade in local currencies, building alternative payment systems. Whether a BRICS currency succeeds is less important than the trend. The world is reducing dollar dependence. When countries de-dollarize, they buy gold. China's been accumulating for decades. Russia accelerated after sanctions. This is a multi-decade structural bid for gold. Here's what most get wrong about timing. Gold's at all-time highs. The trade is over. That's backwards. Gold at ATHs confirms the bull market is accelerating. Silver. Lagging gold is the opportunity, not a warning. Silver typically lags in early stages, gold leads, then capital rotates to silver for leverage. That rotation is just beginning. Technically, gold broke out of multi-year consolidation. Silver's breaking out from similar patterns, but at lower relative levels. The ratio is compressing. We're in early to middle stages, not late. From positioning, gold is getting more attention, but still underground institutionally. Silver is deeply unloved. Most portfolios have zero. That's the classic setup for explosive moves. Here's how to position. If you have zero precious metals exposure, that's a problem. In this environment, negative real rates, currency debasement, geopolitical instability, having zero gold or silver is taking on more risk, not less. I'd suggest 5-10 of portfolio in precious metals. Within that, 70% gold, 30% silver if you want stability, or 40% gold, 60% silver if you want leverage on the ratio compression. For vehicles, 30% physical for insurance, 40% ETFs for liquid exposure, 20% streaming or royalty companies for leverage. Plus cash flow, 10% quality miners for maximum upside. Entry strategy, dollar cost average over 3-6 months. Don't try to time it perfectly. Exit framework, don't anchor to arbitrary prices. Watch the gold-silver ratio when it hits 25-30. We're in late-stage territory. Watch sentiment when precious metals are on magazine covers and relatives are asking about gold. That's mania. Scale out then, not at some random price level. Risks. The biggest is if real rates rise substantially and stay there. If inflation falls to 2% and rates stay at 5-6, the opportunity cost of holding gold becomes significant. My view, governments can't afford this with debt to GDP over 120%. They're biased toward keeping real rates low. Second risk is deflationary collapse where commodity demand craters. Silver would get hit hard on industrial demand, though central banks would fight deflation aggressively. Third is geopolitical resolution. If tensions ease, some of the geopolitical bid could dissipate. Low probability given the structural de-dollarization forces. Manage risks through position sizing 5-10, not 50%, diversification across vehicles, and staying informed. Don't get shaken out by volatility. Sharp corrections within bull markets are normal. My base case, gold reaches 35004000 by late 2026-2027's 40% gain. The risk-reward is asymmetric. 20-30 downside if thesis breaks, 40100 upside for gold and 25x for silver. This isn't about making a quick trade, it's about positioning for a multi-year trend driven by structural forces: currency debasement, de-dollarization, supply constraints. These don't reverse quickly. Once positioned, hold through volatility and wait for the thesis to play out. Most investors fail here. They buy gold at $2,000, it drops to $1,800, they panic and sell, then it hits $2,500 and they buy back, then it corrects to $2,300 and they sell again. They trade themselves out of winning positions. If you understand the macro drivers, negative real rates, debt levels, de-dollarization, central bank buying, you hold through volatility. Add on weakness, take partial profits on strength, maintain core exposure. Here's what I'm telling you, most people have no idea what's coming. They don't understand the monetary system is broken. They don't see central banks are trapped. They don't recognize de-dollarization is accelerating. They don't appreciate silver supply is in structural deficit as industrial demand surges. By the time it's obvious, gold at $5,000, silver at $150, everyone talking about it, the easy money is gone. You'll be buying from people who positioned 2 years earlier and are taking profits. The question is, will you position now when it's uncomfortable and the consensus is skeptical? Or wait until it's obvious and comfortable when the opportunity is largely gone? I'm positioned. I've been accumulating for years. I've studied the macro, analyzed supply-demand, watched central bank behavior. Everything tells me we're in early to middle stages of something significant, not a normal bull market, a structural repricing driven by forces years in the making. If this resonates, leave a comment and tell me where you are already positioned. Building now? What's holding you back? Share this with anyone who needs to understand what's happening in monetary markets. Subscribe because we're tracking these themes: de-dollarization, central bank behavior, precious metals, technicals, silver supply squeeze throughout 2026 and beyond. This is serious, not fear-mongering, but the fundamentals are undeniable and most are unprepared. Serious. The window to position intelligently is narrowing, the moves are accelerating, technical breakouts are confirming the macro thesis. Gold and silver aren't just investments, they're insurance against the instability baked into the current system. When global monetary systems shift, and they are shifting, the assets that have been money for 5,000 years get repriced to reflect new reality. That repricing is happening now. Most people are still on the platform debating whether it's real. The ones who understand the macro are already on board. Which side you're on will matter over the next few years.